So today's topic is quite interesting, and I'm picking it up from the previous topic because it was a little bulky, so I could not finish it up. And I decided that I push it forward to today's discussion. And that is money lending as a business reloaded. So we are doing the last bits that we did not touch on. And kindly note that this is not as detailed. It is not as detailed. So what we speak is quite a little different until you experience it yourself. So unless you're doing the business yourself, that's when you can experience, have a bit of hands-on, and know that what we are talking about and how it can be applied. So if you hear all the time, if you're listening all the time, but you're not implementing, you might not feel the touch. You might not have the actual feel of what it is that you're meant to be doing. So it's pertinent that all that you learn, you implement it or you try it out. So as I earlier shared, somewhere, each one of us has ever lended money. You've ever lent money to someone, you've ever lent money to somebody, whether they paid or not, but you've ever lent money to someone. Whether it had interest on it or not, you've ever lent money to someone. So the only difference between what you did and what we are talking about now is that as we lend out at profit, at a certain interest rate, and you could have given it out with no interest rate at all. But even then, you do not have a guarantee that someone actually would pay you back or even paid you back when you lent them the money. So it's pertinent to also learn, or else why not have it as a business? If you can lend interest-free, that means even if you had business, it could still run and thrive. So money lending as a business reloaded, we had reached the level of loan assessment because there are about 6 steps. That is loan application, a loan assessment, a loan approval, loan collection, and after sales services. There are actually 5 steps. So if you have some bit of system, it should rotate around those 5 steps. And in the previous sharing, I hinted on the loan application and a small part on loan assessment. So I'm going to pick it up from there and then take you through faster in the remaining processes. This is to give you a highlight and a glimpse of sorts so that you can actually look out for more knowledge. I personally have a mastermind that I run on the same. So you can enroll and I charge a particular fee. So let's go straight to a loan assessment. So when someone applies for a facility, there are key things that you look at. And among those things is the collateral. So there are several different categories of collaterals that someone could have. But it's not that everything that the client has, you're going to consider it. You as an entity, you as an institution, you should have your category of collaterals that you actually look at. You should have your category of collaterals that you look at, because you cannot serve everyone in the world. So there's a selection of people that you're going to work on, that you're going to serve. And the rest, you leave them to the market, whoever can take them on. So you cannot serve all the world. So meaning that you have to have a bit of a sieve. That's when you can determine who will qualify and who will not qualify. So I'll give an example of what we work with as a company, what we have experience with. So of the collaterals that clients would bring on board, we only can take the car as a collateral. We only can take a land title as a collateral. We only can take electronics. And when I say electronics in this category, we majorly look at the laptops. And so meaning that then you should have a minimum amount of money that you can give. Because for us, we might not be able to give less than 200,000. So the minimum amount is 200,000. and the maximum could go as much as 50 million. So we have a minimum. So I'll go for collateral per collateral. So starting with electronic, usually what happens that if you have your collateral as a laptop, what it concerns you with is that let's say if you want 1 million shillings, your collateral should be 2 million and above. Because as I earlier shared, is that you as a lender, you might not be an expert to attach value to the collateral. So meaning that you need a third party. It could be an individual who is qualified and registered as a valuer or a surveyor. He has to be a registered valuer and surveyor most of the time because you're not an expert. So you could engage an individual or you could engage a company. Now, for us, we work with a company. We have an MOU with them and they do our valuations. They are registered and their reports are recognized in the courts of the law. Just in case the business goes bad, you actually have a fallback position because your paperwork is thorough. Yes, the collateral is very pertinent because especially if you roll it out and you're not lending to only your close friends or relatives, or if it goes public, some of these clients you've not interacted with them, you don't know their character, you don't know how their payment capacities and all, though you even assess, but there's an extent to which you can actually go. So it's pertinent that you're secure just in case someone fails. One, your paperwork should be very good, and two, your collateral should also be very good. I've already emphasized that the file that you get per client, the file of each client, it should be sellable. If I come as Jonan and I want to buy your company, your files should be sellable. I should be able to buy a client's file with the assurance that you did very good paperwork and banking on your collaterals and all the due diligence. I should be able to pay for that particular file, knowing that the client is actually going to pay. And that's the case that happened with Crane Bank while it was taken over by DFCU. The calculated file per file, and there are those files that, because they did not do good work, they are a risk. So if I am buying your company, I cannot buy a risk. So that can cause a devaluation of your company. So that's a bit of a detail for some other time. But for now, yes, we look at the laptop. If I get a person who is an expert, values this laptop, and it's valued at 1 million, we have what we call the market value and the forced sale value. So we look at the forced sale value. Now, why we don't look at the market value is that it might take you a long time to sell that particular piece of item at the market value, because that means you have to wait for clients to offer you that particular amount. But the forced sale is slightly lower than the market value, meaning that if I had a car or if I had a laptop that is worth 5 million and here I am selling it at 3 million, you have very many contenders who could actually vouch to buy it. And your intention, as I always shared with my mentees, is that the intention is not the collateral. So you should not target to take a client's collateral. You should target to recover your money. That's the most important thing. You should target to recover your money. So meaning that you want to liquidate as fast as you can, just in case something goes wrong. So if the property is valued, if the laptop is valued at 1 million, we can only give you, as the first sale value, we can only give you 500,000 maximum. So meaning that if something goes wrong, you have a bracket to work with from the 500 to 1 million, which is the first sale value. So we give you 50% of the first sale value. If it is a vehicle and it's valued at 50 million as the first sale value, we can only give you 50% of that. That's 25 million. So meaning that you can only, if you applied for 30 million, we can only tell you that, you know what, based on this and this and this and this, we are going to give you 25 million max. So those are the collaterals that we look at. And the land, same principle, 50% of the forced sale value. So it's important that you have that at the back of your mind, and what it is that informed the 50% of the forced sale value. Because when the time comes to liquidate that item, there are lots of things that you spend on. Could be lawyers, it could be back and forth, and perhaps it's taking a bit of time. So all those things could be considered in the amount that is excess of the loan that you issued to match up the forced sale value. If I gave you 50% of £1,000,000 shillings for your laptop, taking 1 million as a forced sale value, the back and forth and the time that we work it out could cater for that bracket plus the interest that is meant to cover that bit of a gap. Then I can go straight. I think I've a bit exhausted this bit. One key thing before I leave this loan assessment bit is that as you're doing the assessment, it is pertinent that you also look, because your intention is not to take the client's collateral. So your intention is your money plus the interest. So it's pertinent that you look at the clients and qualify them if they're eligible to take the loans. Because it's not about the collateral. I could be having land worth 100 million and I only need 30 million or 40 million, but I do not have any cash flow. My cash flow is very bad. And how do you look at someone's cash flow? The first thing is to look at the client's bank statement. The bank statement tells you how the money has been coming in, how the money has been coming in. Does the person have a regular income? Does the person have a regular income? Can he or she ably pay? Or you're going to have a back and forth? Because you didn't want to clash with the clients. Because even then, word of mouth has been proven to be one of the best methods that you can use to increase your clientele. So you didn't want to have a back and forth lots with the client. So you want to be in good books, and you also wish that clients be in good books with you as well. That's why it's important that you do not look at the collateral alone in isolation, but rather look at the financial capability and the capacity of the clients to pay back. And that's when you look at the bank statement. And one key thing also based on experience that we have is that some of the clients, you'll find that they issued bounce checks. Now that's a clear indicator that someone, first, he might not be truthful, because why would you issue a check if you don't have the money on the account? But also question someone's character. There are actually some lenders who do not give you money if you have a bounce check on your statement. So it's important to look at the statement with some bit of information so that it can inform your decision whether to approve the loan or not. The other key document that we look out for is the CRB report. Now, a CRB report is all the banks from tier 1 to tier 3. So you might, including commercial banks, including microfinance institutions, those small big microfinance institutions, they submit their data, their clients' data, to the reference bureaus. So you need to check out, you get a CRB report from those credit reference bureaus to check someone's credit history, to check someone's credibility and ability to pay back. Because they also highlight someone's financial stand, the number of times they applied for a loan, because the person could have come to you because he was denied a loan in a particular bank. So you need to ask yourself why he was denied a loan in that institution. And you see the number of times the person tries. And then also it even highlights the number of checks issued if they bounce to something like that. And then also if the person has several other loans, because most of the guys come to microfinance institution and money lenders because they've exhausted all the other options. You find the person has loans in several other banks, and the only option that he has now is to actually come to you, like money lender, to actually get a loan. So it puts you in a tricky situation to lend to a person who is highly indebted. So this CRB report helps you to identify if the person is indebted or not, and how many loans. But you also note that tier 4 microfinance institutions, those are money lenders, they do not submit their data to the tier 4, to their credit reference bureaus. So meaning that the information that you get there are only for banks, commercial banks, and all the tier 1, tier 2, and the tier 3. So those are rankings in the banking industry. So it's important you look at that credit reference report. There is a form that you have to sign and to send to the bureau, and then you pay some bit of money. Client has to confirm with an ID that he has authorized you to actually access that information. So it's pertinent that you look at that as well, because you want to secure your money as much as you can. Many a time, and based on experience, the time we had just started, we used to look at the interest you're going to accumulate from the money you're going to give out. But it's important that before you give out the money is secure in the first place. Before you count your interest, first consider the principal, the likelihood of that principal getting lost or vanishing, because your principal is like blood of your business, and you'd wish to secure it as much as you can. And if the client comes in a hurry, because some of the fraudsters come and they put you on pressure, Jonan, I want it in 1 hour, 30 seconds, honestly, I will not serve you, because then I'll burn my hands, and I'd rather take my time and work with clients that can be patient, and those are the credible clients. Because in the guise of quickness and fastness, that's when you clash. That's when you collide on fraudsters, and you get out of business. If you give a chunk of money, you can ably get out of business, I guarantee you. So I take you to the next step, which is the loan approval. So first of all, in the Bible, in Proverbs, says that amidst many counselors lies wisdom. So meaning that if you inquire to as many people, especially the knowledgeable one in the industry, it is a plus on your side. But also, you should not over-inquire. That's delaying a client before you approve the loan. So in this category, it's important that you have more than one person look at the loan application before you approve it. Because 2 eyes are better than 1. 2 minds are better than 1. Whereas you might miss 1 or 2 things, your colleague might not miss. So for us, we have a loans committee. It should have at least 2 people. So it can be 2, 3, or 4, or any number based on the inflows, the clients that come on board. So it's important that you have more than one person look at a file, so that you can have a balanced view of the file and a complete assessment before the loan is approved. So under the approval, the loans committee has to look at your file, each client's file, because you need to shield your capital as much as you can. So you need to look at that file 360 degrees and in the shortest time possible. So you need to be super fast. As I shared, we are an alternative. Someone runs to us because banks take a bit of time. Give an example. If someone has a consignment at the border and every day counts, he has to pay demurrage, he has to pay warehouse fees and all things. So, the person is super quick. He won't go to the bank. So he comes to you as an alternative. So you shouldn't as much derail him or her because you're an alternative. And that's why we try to be efficient. That's why we are efficient. And we can issue in the shortest time possible, but also we do it in a way that we do not burn our hands in the guise of serving you very fast. Because the fraudsters also take that advantage to defraud of our money in the guise of, I have a quick deal to close. So you need to have it at the back of your mind. So whereas you set up the committee, it's important that they know what they are doing and they do it very fast. Because some of these collaterals, especially for new entrants, for new clients, you actually have to first lodge a caveat. For example, in the car logbook, because we don't park cars. If you're going to give to maybe 300 clients or 1,000 clients and they all have cars, where will you get a parking lot for all those cars? So what we do is that you caveat the logbook and also install the tracker in someone's vehicle so you can keep with his vehicle comfortably and you can keep paying, but you also secure on your end. First, the car is caveated. Secondly, the car has a tracker. We had a bit of insurance, comprehensive insurance, just because the car could get an accident, but it depends on how busy the car is. So if it's a private vehicle, you might not necessarily look at the comprehensive insurance. But of course, some companies look at the comprehensive insurance. So it's important that you look at all those things. If it's a land as a collateral, you need to mortgage it. And if it's a marital home, the wife has to sign on the documents as well, so that you can be 100% secure. Guys, before you look at the interest, it's important that you look at the principal. The key word is secure thou principal. Secure thou principal. Look at the principal before you look at the interest. So make sure that there's no likelihood whatsoever. Of course, default clients will come, bad clients will come, but still make sure you are at your A game. That even if something went wrong, you're not the one to blame. You did your part, and there is always a way how you can actually recover. So that is it with the step of the loan assessment. It has to be done super fast, and let it be more than one person to look at the client's file. Let it be more than one person to look at the client's file. So that's it at the loan assessment, loan approval, sorry. So after approving the loan, then it's important that, because some clients, based on experience that we have, is that other clients come and they say, Jonan, I want hard cash. Honestly, I will not give you hard cash. Whether you're applying for 500,000 or 1 million or 50 million. Because at the end of the day, when things get out of hand, you need to have the evidence that you actually gave this person money. Yes, granted, they signed a letter of offer, but in addition to signing a letter of offer, you need to confirm the actual transaction. That's why it's important that the money is wired to the client's account. And that account has to be in the client's names as a borrower. And if it's a phone, then the phone has to be registered in the client's names as well. Because that's the evidence of the actual transaction. That's evidence that you actually wired the money to the client. So we strictly wire the money to the client. And you know, with this online banking, we have the option of RTGS, the rapid transfer. So it's more like mobile money, it's more like cash. So you can apply for a loan and I wire it in a matter of, minutes. In 10 minutes or 15 minutes, RTGS, you have the money on your account or your phone. It's something very important, because when things get out of hand and you're going to go to the court, because sometimes you can't avoid some of the things. You can't have all your clients and they're all good unless and you cannot refuse to get in business because of the risk, because everything has a risk. Even you moving out of your house is a risk. Crossing the road is a risk. Driving on the road is a risk. So you cannot stop doing business just because there are risks, because I guarantee you we have the risks involved. So it's important that you shield yourself as much as you can. Shield your company as much as you can. That's why I emphasize some of these key notches, those key steps. So you need to wire the money to the borrower's account details, the bank details. It has to be in his names or her names. If it's a fraud, it has to be registered in their names. It's very, 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 very important. So I'll take you straight the last bit, the second last bit, which is the loan collection. Now, you've always had a proverb that a person comes to you, you give them the money while seated, but you collect the money while standing. It is true. And based on experience, it is a fact and it is true. Of course, it doesn't apply to all the clients, but it's important to note that this Vantage has some solid muscle in it. You give someone money while seated, but collecting it is always a hassle. And if you do not collect as much, you might get out of business. Because clients tend to hold money. Postponed, I'm going to pay, but for how long? So it's important that you handle it, address it at the neck point. Based on the time that the client has applied for a loan, it's important that, first of all, you notify the client. Now, for us, we've gotten to a particular level, yes. You could be starting, but it's important that you get a way you can remind the client. If you've not afforded the system yet, like we have, because we pay for a system and it's a little costly per month. So if you've not gotten to that level yet, it's important that you look for a way. You can get your loans officer or even you yourself. If you're operating a business, it's important that you notify the client maybe 2 or 3 days before the due date, so the clients can as well prepare themselves before the date and they prepare to pay. But in case the client fails to pay, it's important that you have a mechanism through which you can actually take them on when it's still very early. Because on our case is that after 5 days, because of course we notify you and the system notifies you 2 or 3 days before the due date. Then after the due date, the date reaches, and then 5 days after the due date, we serve you with what we call a demand notice. Now, you kindly note that you might have to read or engage a lawyer, because some of these clauses are important and they are in the Moneylenders Act and the Regulations 2016. So you may need to read the Moneylenders Act, Tier 4 Microfinance Institutions and Moneylenders Act. You need to read these documents to acquaint yourself with these key things, because when you get to the courts of law, all these things are important. Did you issue the person demand notice? Do you have evidence? For example, if I post it to the borrower's post address, I'll get a post office notification. If I send it on WhatsApp, there has to be a bit of detail. If it's an email, so you have to confirm actually that you sent this letter and it reached the client. It is very, very important. So after the 5 days, send demand notice, and then there are times that you have to send them. After 7 days, then you send the third time. That's when you send the default notice, and then you start planning on foreclosure. Because if your client cannot pay in all that period after warnings and calls, then it's important that you take a step forward on how you can actually recover. So not all the recoveries you'll go through a hassle, but granted, most of the clients, some of the clients, you actually have to go through the hassle, and there's no one else who has to go through it but yourself. So it's important that you have at the back of your mind, for those who haven't joined the industry, that all this has to be prepared for. All the things you have to actually go through them. So you have to prepare for them. So I will not go to the detail. If you're interested more, I have a few guys that I mentor. You can also get on board and we walk this journey together, because experience in money lending is very expensive. If you're going to learn by experience, it is very expensive. You can imagine if you give a client maybe 20 million or 30 million and you have a capital of 100 million, how many more clients are going to serve before you get out of business? So it's important that you get a mentor who can walk with you the journey, who can support you, whom you can learn from, and who can guide you accordingly. Because this country or this world is full of fraudsters, is full of con men, is full of guys who might not wish you well in your business. So it's important that you acquaint yourself, you shield yourself and shield your capital and shield your business, or else you might run out of business. So the last bit, as I see time is fast spent, the last bit is after sales services. So it's important that you have a follow-up mechanism to your clients, especially the good clients. And I'd recommend a particular book called The Pumpkin Plan. Sieve your clients. Target those best clients. If you're blessed by the Lord and you at least have taken a step to another level, it's good you look at your clients, look at the good clients, concentrate on those. Tell them of your services all the time. Reach out to them, wish them give them birthday messages, from your system or text messages. Celebrate with them if they have weddings or a few things in their lives, anniversaries. Support them. Because good clients will refer you to more good clients, and word of mouth is one of the best marketing methods that has ever existed. So I see our time is fast spent, and we cannot discuss all of it here in these 30 minutes that we have at hand. I'd like to appreciate your time, and it's always a pleasure. I always look forward to share with you. Check out this on YouTube and a few things that I share on. And also check our website out, www.jonakihholdingslimited.com. And YouTube, you just type in my name, Jonan Kandwanaho, and you'll be able to enjoy the videos that I always share every Friday from 5:30 to 6. I want to appreciate you. Thank you for watching, and endeavor to implement one or two things that you learn from my sharing.